Welcome to the recorded workshop session for the Accounting Distance module.
Good morning, everybody. Welcome to our workshop for today. And I have to say, I was impressed with the way you performed in your assignment. So it shows that you put a lot of effort. And I am having absolute confidence that if you keep that spirit up, you're going to do very well in the exam. All right, so today I would like us to have a look at four things. All right, we are firstly going to proceed with our subsidiary journals, and we are going to do our debtors ledger, which has got debtors list in it, and then we're going to be looking at the salaries. Most of you have received the salaries today, and I wonder if you can calculate net salary for yourself. So we're going to be doing that exercise, and finally, we are going to be looking at how the business calculates the profit or loss in its operations. All right, so let's get started. All right, so to make it easy for us, we have the questions with us. And just before we actually work on the questions, I want us to revisit the principles behind what we're doing. All right, so we have the subsidiary journals. So this section is called Subsidiary Journals. Right, subsidiary journals. And with subsidiary journals, we have four categories. What I do is I break them into four categories to make it easier for you to understand. All right, so the first category of our transaction is that we're dealing with transactions involving cash. All right, so in this category, what is key is cash. If as a business, we are transacting using cash, we're going to use the subsidiary journals in the first category. And we have two main subsidiary journals. We call the first one Cashbook Payments Journal. All right, so this is our first book. So in this journal, we only record transactions involving the payment of cash. So whenever the business pays cash, we're going to record the transaction in this book. All right, so as I said, the keyword is cash. In this instance, what are we doing? We are actually just paying cash. So this is actually self-explanatory. So this is where we record transactions involving payment of cash. All right, you remember our keyword is cash, and what we're doing is we are paying cash. So every time the business is paying cash, it's going to be recorded in this book.
So may I ask a question? Is that hard cash, actual notes, or how? The keyword is cash. Is that hard cash?
Very, very good question. You're a bright student. All right. So cash basically can be electronic transfer. You don't have to have a physical cash. You can pay, these days we can pay by doing a direct deposit, depositing the physical cash. But secondly, we can also pay using check. And we can do our payments also using EFTs. All those will actually be equivalent to cash. I like your question. So every time you pay, whether physical cash or non-physical cash, we're going to record it in the Cash Payments Journal. And the second book that we have is the Cashbook Receipts Journal. Right? So already you can see by the keyword that we are dealing with receipts. All right. So whereas in the first category, we're dealing with payments, in the second category, we're dealing with receipts. So in the cash receipts journal, we are recording transactions. So we're recording transactions involving the receipt of cash. All right. So this is where we record transactions involving receipt of cash. So the keyword is cash and the other keyword is receipt. So in this instance, we are receiving cash, whereas in the first instance, we are actually paying cash. And another subsidiary journal in the cash category is called PT Cash Journal. All right. So with respect to PT Cash, the keyword is PT. So PT means small, little, trivial. All right. So in the PT Cash, we record transactions involving cash, but we are only talking about those transactions that involve little cash. For instance, the money that we use to get our tea and coffee at work. All right. Tea and coffee doesn't cost much. So for those small incidental expenses, we're going to record them in the PT Cash. All right. So here we are talking about transactions involving payment of incidental or insignificant expenses in cash. All right, so this is our first category. So whenever you come across a cash transaction in the business, you must know that we can either use the Cashbook Payments Journal, Cashbook Receipts Journal, or PT Cash Journal. All right, so this is the first category. So remember, the key word in the first category is cash. So we move to the second category. All right, so let's move to the second category. So our second category deals with something different to cash. All right, so let's just take it up. All right, let's just take it down. All right, let's just fix it so that we can be able to proceed. All right, so we get to the second category. So the second category is where we are dealing on credit. While the first category was dealing with cash transactions, in the second category, we're dealing with credit transactions. All right, so here we have transactions involving trading on credit. All right, so here we've got two subsidiary journals. All right, the first one, we call it debtors journal. So we've got debtors journal. All right, so we need to remember who the debtor is. All right, so the debtor is the customer we're selling to on credit. All right, when that person owes us money because we have sold to them on credit, we actually refer to them as debtors because they are having debt in our business. All right, so that's why we call them debtors, because we will have traded with them on credit. All right, so we can say debtors journal is a book where we're recording credit sales transactions to the debtor. All right, so this is where credit sales transactions to the debtor are recorded. Right, so that will be your debtors journal. And the second journal in this category, we call it creditors journal. Right, the opposite of debtors. So here we have customers we're selling to on credit, but with creditors journal, it's the suppliers we are purchasing goods from on credit. So with creditors, we are buying, and we owe our suppliers. We call them creditors. All right. So this one, we can therefore say it's a book where we record credit purchase transactions, all right, from the suppliers. So this is where purchases made on credit from suppliers are recorded. Right, so you can see that both contain the keyword credit. Credit. So that's different from the first category, which involved cash. All right, and we move to the third category. All right, so here we're dealing with transactions that are involving returns. All right, so if there was anything wrong with our credit sales transactions, we are going to bring them into this category. If there was anything wrong with the purchases we have made from suppliers on credit, they are going to come to the third category. What can go wrong? So sometimes it happens that you, the debtor, purchases goods from us on credit, but the debtor is unhappy with the quality. So what will they do? They'll bring back the goods. All right, so that's what can go wrong. Sometimes they buy on credit from us and we overcharge them. All right, so they will come in and complain that we have been overcharged, so we will need to rectify those errors. And such problems are actually rectified in the third category. Okay, all right, so let's just go to the third category. All right, let's go for it. All right. All right, here we go. Okay, so that's all good. So it brings us to the third category. So in the third category, we deal with transactions involving problems with transactions in category 2 above. All right. So problems involving credit sales to debtors will be recorded in the Debtors Allowances Journal. All right, so here is when the debtor is returning the goods or we have overcharged the debtor. All right? So here we'll have transactions involving goods returns or overcharged transactions. All right. So remember, this must relate to the credit sales. All right. So here we're saying if we had sold to a debtor on credit, yes, my students?
So I just want to ask you, what happens if it was a cash transaction, the very first category?
All right.
Your subsidiary, and it's still a good return or overcharged?
All right, that's a brilliant question. I'm so happy with your question. All right, it won't come in here. All right, let's explain the process. So if you had bought for cash from our business, what will happen is we will have received your cash. So in other words, we'll have recorded that transaction in the Cashbook receipts journal, isn't it? Mm. Correct? But then if you are unhappy with what you've sold to you, you're going to bring back the goods. And then what are we going to do? We are going to pay you. We're going to refund you your cash. So that will actually go to the Cashbook payments journal. Do you see that? All right. So this will actually involve transactions if we had traded on credit. Okay. All right. So the second one is the Creditors Allowances Journal. So we have Creditors Allowances Journal. So here the suppliers have either overcharged us or we are returning goods to the suppliers. All right, so this is when the business returns goods to suppliers. All right, or when the business had been overcharged. All right, so those are going to come to the Creditors Allowances Journal. So we've got the final category. All right, so the final category, we say it's transactions not falling within any of these three categories mentioned above. So those transactions we are going to put in the general journal. Hence they use the word general because they don't put specific transactions in them, but it's those transactions that cannot be classified into any of these categories. So I say here is transactions not falling within the above three categories. All right, so those transactions, we put them in the general journal. Okay, so they are going to come to the general journal. All right, so this should actually make it easier for you. So when you are given a list of transactions, so the skill that you need to develop is to know where, in what book, that particular transaction is recorded. Hi?
Yes, I want to ask you, if it's not cash, it's not data, and it's not on credit, so it's not cash, it's not selling on credit, and it's not buying on credit, what other transaction could it be?
Very good question. All right. So let's just say the debtor was owing us. All right. So the debtor had money outstanding. So what happens is we charge the debtor interest. All right. So if we have a transaction like that, let's try and check all the above three categories and see if it will be able to fit. All right. We say, remember, our transaction is we're charging a debtor interest on the overdue account. Number one, are we involving cash? No, there is no cash received or paid. We are just charging interest. Are we either, second category, are we either buying or selling something on credit? Absolutely no. All right. Number three, have we been overcharged, or is the customer retaining the goods? No. And we are not retaining the goods also. So that's why that transaction is going to come in the fourth category, because it does not actually fit in the above three categories. So what you do is you make sure that you understand your categories very, very well. So if you get any transaction, just ask yourself, can I fit in any of the above three categories? Because you know what those subsidiary journals are. If the answer is no, it must come to the general journal. All right.
Sorry, sir, I'm not clear. What, besides interest, what other transactions could there be?
The transactions could be, so we're charging a debtor interest. Sometimes we can write off a debtor because they're not able to pay us. Right? You see, when we write off a debt, there is no cash involved. We are neither buying on credit or buying goods on credit. No one is retaining the goods, or have we been overcharged. We are basically just writing off a debt. All right. So that transaction as well will not actually will actually not come in the above three categories, but it will come to the general journal. All right. So general journal should be your, I would say, your last resort. If ever you come across a transaction and you can't fit it in the above three categories, that's where we're going to take it to general journal, because it is the journal that we use for general purposes. All right. So I like your questions because they are quite brilliant. All right. Okay. So now that we know, all right, you have another question. I like questions.
I'm sorry, I've been very, because to me,
Yeah.
a transaction is a transaction.
Yeah.
It's between people. Trans means across. So it's an action across.
Yes.
So cash is a transaction. On credit is a transaction. When somebody buys from me, it's a transaction. even if they bring something back, it's still a transaction between us. But if I'm just charging interest, it seems to be one-sided. I'm not sure I would know to put it into that because I wouldn't see it as a transaction.
All right, so it would be a transaction, and my take will be, if you are buying on credit from our business, what's going to happen is we're going to give you our credit terms. We're going to say, you need to pay after 3 months. If you don't pay after 3 months, we're going to charge an interest of so much. All right. By actually agreeing to those terms, that's a transaction. So it's something that we have agreed upon. All right. Thank you very much. You have some very intelligent questions. That's great. All right. So now, let us go into put this in perspective. So we know the theoretical aspect of it. So let us go and look at the transactions and see if we can be able to determine where they are being recorded. All right. So here, what we're doing is we just want to see if we can see where the transaction is going to be recorded. All right. So we're going to have a look at our list of transactions here. All right, and what we'll actually be talking through as well is these source documents, all right, because we just see the codes there and we don't know what these are all about. All right, so let's start with the first one. We got, they say, invoice. So IV stands for invoice. All right, what does invoice imply? What actually comes in your mind when you see the word invoice? It basically means there is credit involved. All right, so invoice, you only get invoice. Remember, you can get an invoice even when you are buying for cash. So we usually call that cash invoice. All right, but in our transaction, if they mention the document IV, they are referring to credit invoices. All right, so here, all right, let's just see, let's just start from the beginning, right, because this is not right at the beginning. All right, let's go to the beginning so that we don't skip some transactions. All right, here we go. So our technology is behaving, that's very good. All right, here we go. So let's start with the first one. All right, remember here our exercise is knowing where the transaction, in what book the transaction is supposed to be recorded. All right, so let's look at on the 9th. All right, oh look, sorry, we are not at the top. I see, because of the date. Yeah, now we are at the top. All right, so let's look at number 1. So details basically will indicate who we are transacting with. All right, so the date, that's the date on which the transaction is taking place. And then source document, it's a document that is given to the person we are transacting with, or a document we are receiving from the person we are transacting with. All right, so here they describe the transaction that has taken place, and then you've got the amount in the last column. All right, so number 1 is saying we have bought inventory, and then the source document is invoice. We have purchased inventory, and the source document we got here is invoice. So what it means is we have bought inventory on credit. All right, so going back to our subsidiary journals, where will we put this? All right, so we have the second category, the first category involving cash. So we say it's invoice, so meaning it's not for cash, so it can't be in this category. So can it be in this category? Let's see. So let's see if it can be here. All right, let's take it up. All right, so it does cooperate. All right, but we can remember this. All right, we'll just take it down. As you can see, in this category, we say we have the debtors journal and the creditors journal. All right, so will it belong to this category? So let's say debtors, we say it's when we are selling on credit to the debtor, and creditors journal, it's when we are buying on credit. All right, so let's look at our transaction here. So you see, we are buying the inventory on credit, so which means this one will be recorded in the creditors journal. All right, so this one will go to the creditors journal. So remember, with this kind of questions, if you know where the transaction is supposed to be recorded, that's 95% of the battle won. Because if you take it to a wrong subsidiary journal, you're going to be marked, you're going to be given 0, because it shows that you don't know where transactions are supposed to be recorded. But I know you won't make that mistake. Okay, so the one on the first, so the first one will take it to the creditors journal because we are buying inventory on credit. So on the fourth, what's happening is we are paying. Look at that. So we are paying for business plumbing. All right, and here we have a source document. They call it CC. Right? What is CC? All right, CC is what we call a check counterfoil. All right, so CC is a check counterfoil. All right, many of you know this as a check stub. All right, when you issue a check, there is a very small document which contains the same transaction. We call it check counterfoil because remember, as a business, if we are paying, we are giving the original check to the person we are paying. So the person then disappears with a check. So we only have the evidence from the check counterfoil which we can use to record the transaction. All right. So if we are paying, it means that there is cash involved. So if we had check counterfoil, it means we paid by check. So hence your brilliant question was actually very helpful because you are asking, do we always use physical cash? So here is an example where we are not using physical cash. So this one will be in the Cashbook payments journal. All right, so it's Cashbook payments journal. All right, so I just want to use the correct abbreviation. All right, so I'll say CBPJ. All right, Cashbook payments journal. All right, so we go to the one on the 5th. All right, so you see there is a document here. So here we are returning the inventory to the supplier. All right, so we're returning inventory to the supplier. So you see here's a document here. You see OCT, so this is not October. All right, this is not October. This is original credit note. All right, so OCT stands for original credit note.
What does the T stand for? In OCT.
It's actually not, it's just the code given. So it's actually, this CT is just credit, is the C from the beginning of credit and T right at the end. All right, so what usually happens is when we return goods to the supplier will give us an original credit note. All right, so that original credit note is an evidence for us that we have indeed returned goods to the supplier. So in other words, the amount that we owe to the supplier must be reduced by the value of goods we have returned. All right, so the supplier will be left with a copy. We will have the original credit note that we can use to record our transaction. All right, so remember from our categories, 3 categories. Let's see, will it come under number 1? No, not cash. Under category number 2? No, because we are not buying on credit. We are not buying goods on credit. All right, we're not selling on credit. All right, so it means we have to go further to category number 3. All right, so let's see if it cooperates. So it looks like it's moving. Oh, here we go. So here we go. One more time. So it's going back. All right, but we can remember that. We can remember that in the 3rd category, we have 2 subsidiary journals, and that's your debtors allowances journal and the creditors allowances journal. So we said when we are returning goods to the suppliers, we are going to use the creditors allowances journal. So this one will go to the creditors allowances journal. All right, so let's look at the next one. Drew a cash check for PT cash. Right, it's an interesting one. All right, so we drew a cash check for PT cash. So can you see the similarities here? So we wrote out a check. So this is a check counterfoil, a copy of a check we have issued. All right, let's try to understand this transaction. So this transaction basically means as a business, we wrote out a check for 24,375. All right, so we actually issued a check. So someone had to go to the bank with a cash check of 24,375, and the bank gave that person this cash that will be used for PT cash purposes. All right?
When in the category with cash,
yes.
category 1,
yes.
it said petty cash was for insignificant items.
Yes.
But 24,000 Rand is not an insignificant amount.
Okay, I can see that's scary. But here, we are actually not using PT cash money. So this will be the amount that we're getting from the bank to be used for PT cash purposes. So at this stage, our box is empty. All right, so the money has run out. We don't have money for tea and coffee. So, but what we must do is, because for us to have that money in the box, so we must go and cash a check at the bank. So this is basically a transaction that will go in the Cashbook payments journal. All right, because what we are doing here is we are issuing a check. So this check is not buying tea and coffee. So we are just going to cash it. All right. So once we have that cash in the box, then we'll start taking 50 rands and use it to buy coffee. We'll start taking 20 rands and use it to buy milk. But I see you are very concerned about this amount of money. So at this stage, we are issuing check, all right, to cash it for PT cash purposes. That's not a PT cash transaction. It's basically a cash payment, all right. So that's why we put it, because remember, every time we issue a check, so we have to record it in the Cashbook payments journal because we are making a payment. But once we have this 24,375 in the box, and then we start taking 50 rands to buy coffee, so we will start recording those transactions in the PT cash journal. So when we start using this amount available for petty cash, we will take those transactions to the petty cash journal. All right. So I know it is confusing at this stage, but you'll actually get it as we go by with this, as we continue with these transactions. All right. So don't be too concerned at this stage about this amount of money. All right. So let's go to the next transactions. All right. So we are fine with this. So let's move on. So we'll just need to erase. All right, so let's come here. All right, let's go up a little bit. All right, so here we go. All right, so it's working out nicely like that. I like that when it behaves like that. All right. So let's look at what we have. So I'm sure now we are gaining momentum. We can do these things pretty quick. All right, so see, now we can already see the keywords. So CC, check counterfoil, we must be paying something. All right, what's happening is, oh, we are paying the supplier here. So we are settling an account with the supplier. All right, so if we are paying cash, we know that that transaction must go to the Cashbook Payments Journal. All right. So now we are buying inventory. All right. And CC. CC means it's a check counterfoil. So we are buying inventory using a check. All right. So that's also a cash transaction, which means we will put it in the Cashbook Payments Journal. All right, so these source documents also communicate a message to you. All right, if you know the source documents, even before you read the transaction, you can form a prediction or an expectation as to where that transaction is going to go. All right, here we are purchasing inventory. Look, they're similar. All right, but what's the difference? The source documents. All right, so in this instance, we are using a check to do our payments, but here we are using invoice. So it means we are buying on credit. So if we are buying on credit, we know very well that the transaction will be recorded in the Creditors Journal. All right, so that's what the invoice is telling us. All right, so now we come to a strange document. All right, so let's see this. All right, so they say, B Moodley contributed furniture and fittings to the business. All legislative requirements have been met for the full VAT amount to be claimed. All right, so let's start with these GR. All right, GR is already trying to tell you where this is going to go, because JR is journal voucher. All right, so what this means is that this transaction will go to a general journal. But because we know the principles, let us not be, guided by the source document. Let's think through the process. All right, so the order is contributing furniture to the business. That's our transaction. Now we go to the first category. Is there cash involved? No, there is no cash involved. All right, we go to the second category. Are we buying or selling on credit? Oh, absolutely no. So we go to the third category. Are we being overcharged, or are we overcharging someone? Are there any returns of goods involved? Absolutely no. We say when that happens, you actually take your transaction to the general journal. All right, so usually the document here, which is a journal voucher, is a signal of where you need to take the transaction. All right, so by now we already know, CC, we are buying inventory. Where are we going to put it? obviously we know that it's going to be in the Cashbook Payments Journal. But they got a question mark there. All right, you're looking for the amount, and all that you come across is question mark. So what do you need to do here? All right, I just want to help you with that mark there. All right, it's very important. Okay, so you see, this person, so the business bought the goods at 46,250. But you see, they say the business got a discount of 10%. All right, so if the goods were worth 46,250 and we get a discount of 10%, it basically means we are going to pay 90% of the amount. All right, so the amount must be what we are paying, because in the Cashbook Payments Journal, we only record the payments we do. All right, so let's see what amount we're going to have then. So we're going to have 46,250, all right, minus, so 10% of 46,250 will be 4625. All right, we'll have our lovely magical calculator here that we can use to actually work out how much is supposed to be in there. All right, so if you have a calculator, I'm sure many of you have got a calculator like this. It's very easy. So all you do is you say 46,250 minus 10%. All right. Okay, so it means I have to do it the other way. Okay, so let me do it. So we say we have 46,250, because we can actually first double check that the percentage we have calculated is correct. So what we're going to do is we're going to say 46,250 times, okay, 10%. 10%, oh, look, we're getting it. All right, so you see 10% is 46,250. How do we calculate it? We say 46,250 times 10%. Let's do it again. So we say 46,250 times 10%. Here we go. So we have 46,250.
Then you push the minus?
No, it's equal sign. So let me...
Minus thing. My answer is 41525. So if you say 46250...
So 46250 is the total amount. So 4625 is the discount that we got. All right, so what I was doing here, I was showing you how to calculate the discount. All right, so now that we have calculated the discount, we can calculate the amount that we'll have to pay. So that amount will be 46,250 minus 4625. Right, so that will be the amount that is supposed to be there. So we're going to say so let's get back our lovely calculator. What did we say the amount is?
41625.
Correct. So 41625. So when you see a question mark in the block, it means that you need to calculate the amount yourself. Yeah.
So may I go back to this one before where Mr. Moodley contributed furniture and fittings? Contributed.
Yes.
So you gave it. Why is that not part of equity?
It is actually part of equity. It is part of equity.
Why is it a transaction?
Because by contributing furniture to the business, so he is basically transacting with a business. All right, so remember, here we are dealing with subsidiary journals. So we want to know in what book we are going to record it. All right. So there is a section that we dealt with in the first workshop where we were dealing with accounting equation. So accounting equation says assets equals to equity plus liability. So if we were answering an accounting equation question, so we will put that capital in the equity. So because we're going to have an asset and the equity. So the asset will be the furniture, equity will be capital. So we will put 22500 under assets and equity. But in this question, we are dealing with the books that we use to record transactions. All right? And the books that we use to record transactions are Cashbook Payments Journal, Cashbook Receipts Journal, Petty Cash Journal, Creditors Journal, Debtors Journal, Debtors Allowances Journal, Creditors Allowances Journal, and General Journal. So we've got 8 books that we have to record transactions. So every transaction that we come across must be recorded in either of these 8 books. All right. So hence, what we have here and helps us in the decision-making process to see in what book we're going to record it. All right. So it will still, even when it's recorded in the Cashbook Payments Journal, the equity element does not disappear. We are going to put it as capital in that book, which is in the Cashbook Payments Journal. It will be recorded. Oh yes, yes. In the sorry. So in the General Journal, we will still record that equity. All right. So it does not disappear. All right, because accounting, it's a very logical and principled subject. So everything has to be consistent across the board. All right. So you'll see as we continue with this course that we will deal with financial statements. And when we deal with financial statements, this will also be in the equity section of the financial statements. All right. Okay, so we move to the next one. So you're picking up the pace. So now we have the invoice. So we are buying packing material on credit. So it must come to the Creditors Journal. And then here, CC, it basically means that we are paying for cash using the check. So that will go to the Cashbook Payments Journal. All right, so we'll take it to the Cashbook Payments Journal. All right, so just need to erase this. So I'm sure by now it's becoming easier and easier for you to know exactly where the transactions are supposed to go, which is the most important thing in this section. Okay, so let's just, is this? Yes, this is what we busy with. Okay, so is this? Okay, so let's go back to the next page, the previous page. Okay, so I'm sure this is where we're supposed to be now. All right, so let's go up a little bit. Okay, let's go up a little bit, up a little bit, up a little bit. Okay, so where were we? Were we right here? Oh. Okay, so let's go back a bit. Okay, so we get in there, 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 and here we
Yeah, there we are.
So yes, yes. So that's where we are. So we dealt with the stationery
Yes, on the 16th of October.
on the 16th of October. All right, yes. So that's where we are. So we say this one is going to go to the Cashbook Payments Journal. So we move to the next one. So the next one here is we're using invoice, so meaning we are dealing on credit.
The trading inventory return to the supplier.
Oh, okay, good. So on the 16th, we are returning goods to the supplier. All right, remember this original credit note. That's our source document. So I'm sure you already know where it goes. So it will go to the Creditors Allowances Journal. All right, so the next one, we are purchasing staff room coffee machine, all right, for the purposes of staff entertainment. All right, so we are buying a machine and then we are using the invoice. So we are buying this machine on credit. It will go to the Creditors Journal. All right, so the next one, we are purchasing a laptop. It's a similar thing, all right? We have the invoice, and then we're purchasing that laptop on credit. So it's a Creditors Journal. And then the next one, on the 18th, we're using a check counter for it. What are we doing? We are purchasing a vehicle for cash, all right? So that is going to go to the Cashbook Payments Journal. All right, so and then we've got a question mark again. So a question mark is very interesting. All right, when you see the question mark, don't stress. All right, it means you are going to be doing some lovely calculations. All right, so let's go for it. Okay, so let's go for it. Let's see what they say. So, okay, so where are we? Let's go up. Is it here?
Yeah, it's the 20th.
Okay, let's just move it down a bit. Just a little bit, a little bit, a little bit. Okay, I moved it too much. Okay, so we're gonna go. So here, are we here? Yes. So we are here. Okay, so let's look at that. All right, so here it means we are paying. So it's easier to sort out this one because if we're paying by cash, it will go to the Cashbook Payments Journal. But the question mark means that we need to work out a number. All right, so let's work out a number. So a settlement of account with Gordon CC less 10% settlement discount. All right, so what are really these settlement discounts? So we get settlement discounts if we are paying on time. So usually the supplier will say, if you pay within this period, you will get a settlement discount, which means the balance we were owing will be reduced by a specific percentage. So what it means here is we were owing for 140, and the supplier says he is going to give us a discount of 10%. So in effect, what this means is that we must work out the difference between the two. So we must say for 140 minus 10%. All right, 10% is usually very easy to work with. All right, because what it effectively means is that you always take the last zero. So if you're calculating 10%, if you take the last zero, then the remaining values become your 10%. So in this instance, our settlement discount will be 4,140. All right, so let's try to get our calculator. 414. Thank you very much. So that's going to be 414. All right, so let's get our calculator. All right, so here is our calculator. So just to double check that we have the correct 10%, we're going to say we just want to calculate the settlement discount which was given to us. We're going to say 4,140 times 10%. Right, so we have 414. All right, so every time you calculate 10%, just take the last zero, you've got your answer. All right, so now we want to calculate how much money we're going to pay. So after we have been given a discount of 414, okay, so this is how much we are going to pay. So we're going to pay 3728. Okay. So let's see, let's just double check. Let's double check. 3726, correct. So all right. So we're going to have 3726 in here. All right, so we're going to have it here. Okay, so and then here they say 10% settlement discount received from Gorton CC for settlement of the account referred to check number 442. All right, so this one is basically related to that. So here we are accounting for these discounts that we have received. So here we don't need to calculate again because here they are just referring to the 10% settlement discount. So the number we have is 414. So these two are just interconnected. We are just splitting between what we have paid and the discount that we have received. Okay, so, and then seeing that this is JR, it means that it's going to go to the general journal. All right, because, which makes sense because if we were owing this amount and they are giving us a discount of 414, they are not giving us cash. All right, they are just reducing our balance. So that's why it's going to go to the general journal. All right, drawings by the owner. All right, the owner is taking money from the business. So the business is effectively paying the owner. All right, remember, drawings is an account which is used to describe a situation whereby the owner takes the resources of the business for his own personal use. So whenever the owner takes the resources of the business for his own personal use, we call that drawings. So effectively here, the business is paying out its resources to the owner. So this will go to the Cashbook Payments Journal. All right. So here we have another question mark. Interesting times. All right, so they say drawings of trading inventory with a selling price including VAT of 1875. All right, so we say trading drawings of trading inventory with a selling price including VAT of 1875. All right, tricky one, eh? Okay, so let's look at that. So they are telling us that it's going to go to the general journal by the JR. And so in this instance, with number 21, the owner took cash from the business. With the 21st, the one which follows, the owner is not taking cash. He is taking trading stock, all right, for his own family, all right. And we are told that this inventory has a selling price of 1875, and then these actually includes VAT. All right. So let's just try to remember how much VAT is actually involved in here. All right. So we remember that the VAT percentage is 14%. All right. So we have the VAT percentage, which is 14%. So if we want to calculate the selling price excluding VAT, all right, so let's calculate. What we want to do here, when an amount is like this, it's easier, it makes it easier to work with if you can take the VAT out of the equation and you are left with the selling price. So with respect to this transaction, if we want to get the selling price without VAT, what we do is we take the selling price and then we multiply it by 100 over 114. All right, so this one will give us the selling price without VAT. All right, so when we have the selling price without VAT, we use the formula selling price times 100% over 114. So how are we going to calculate it? So our calculation will go as follows. We will say 1875 times 100 over 114. Okay, so we'll say this is equal to, so we can actually just calculate that. All right, so let's calculate that. So it's 1875 times 100 divided by 114 equals to, so the amount that we're going to have, which is the selling price without VAT, will be 1645. All right, so if the amount includes VAT, so always remember to remove the VAT, you are going to say the amount which is given to you times 100 over 114, then it gives you the selling price without VAT. All right, and be careful when you work with decimals. So if your last number, if the number after the decimal is greater than 5, you just add 1 to the last number. All right, let me repeat. So if your number coming after the number starting your decimals is greater than 5, you just add 1 to the last number there. All right, so our selling price without, all right, so our selling price without VAT will be 1645. Now the question is, if the owner is taking inventory from the business for personal use, are we going to record that inventory at the selling price or at the cost price? We have to record it at cost. All right, because we are not selling. All right, so it's only when we sell that we will use the selling price. So when the owner is taking the inventory for personal use, we will have to work out the cost. So this is the selling price without VAT. So to be able to calculate the cost, we'll just need to see if there is any information given to us that can help us to work out the cost price. All right. So let's just go back a little bit. Let's just see if there is anything they have told us in the. Okay, so what is this? Okay. We're supposed to go back, eh? All right, so let's go see if there is something we can work with. Okay, so here's the information given to us. All right, let's see. Okay, let me just get rid of this. Okay, so let's just go see what they've given us. Okay, so that's what with subsidiary journals. Okay, so this is the same exercise. I suppose it is. Maybe it's is it the? It's not the one. Still not the one. All right, I can see. I can see. So let's just. Okay, all right, here we go. So that's where we are. So because I was seeing something that is helpful from that particular exercise in calculating the cost of the assets. Let's just see if there is any one thing in here that's going to help us. All right, so we should be given the markup percentage. Let's see. All right, so they are telling us, here we go. Here we go. So that's exactly what we wanted. All right, so you see, they're telling us that the inventory is marked up by 40% on the selling price. All right. All right, so this actually solves our trouble that we were trying to get to. All right, let us get this logically. All right, think of selling price as 100% of the amount. So, all right, let's start by saying selling price must be equal to the cost plus your markup. Right? So, because what happens is, when we set our selling price, we say how much has it cost us? And then we add profit, and that becomes the selling price. So, now if we have the cost price and markup, we can just say, okay, our selling price is 100% of the amount. So our cost price is what we are looking for, all right? But they're telling us that the markup on the selling price is 40%. All right, so what this means is we can actually work out how much our cost price is going to be, because mathematically then we just say 100% minus 40% is equal to the cost price. So it means our cost price will be 60% of the amount. All right, so that amount we have calculated, we are going to take 60% of that because that is going to be our cost price. All right, so you can basically, someone can be able to see it from there. Someone can say, all right, so if our selling price has got 40%, the selling price has a markup of 40%. It means that the cost will be 60%. All right. So, but this, I think, can help you to logically see how this works, because in this instance, we have the selling price, which is made up by the cost price plus the markup. And then we just say our selling price will be 100% of the amount we have because it's the selling price. Our markup is 40%. Then we take it to the other side, which changes the signs mathematically. Then we know that our cost price is going to be 60% of the amount. So we can actually go and calculate our cost. All right. So when you answer the question, it means it's very, very important to read the whole information that's given, because some critical information could be given to you right at the beginning. All right. So let's go for our transaction and put the amount. All right, so where are we? So we 20. So we are 21st. Is it here? 22nd? No, 21st here. Okay, cool. All right. So what we said, how much was our amount without VAT? So we said 1875. We said the selling price without VAT. VAT was equal to 1875 times 100 over 114. All right, so let's do it quickly. 1875, all right, times 1875 times 100 divided by 114 equals to, all right, we said it's 1645. All right, so we are saying that the cost price will be 60% of the selling price. So when we calculate the cost price, we are going to say, okay, the cost price is equal to the selling price, which is 1645 times 60%, because we said the cost price will be 60% of the amount. So now we can calculate our cost price. So we can say 1645 times 60%. So then our cost price is 987. All right, so what I suggest you do is you go through it over and over and over again. So let me just go back to the 3 steps that we have taken to get to this calculation. Firstly, we must work out the selling price without VAT, because VAT does not belong to us. It belongs to the taxman. So we must have the amount without VAT and then go and look at our profit margin, all right, which was 40% of the sales. So if it's 40% of the sales, it means the cost will be 60%. So we can actually just put the amount here. So on the 21st, we are going to put the amount here as 987. Okay, so now we have a credit invoice. All right, so here the supplier decided to give us the rebate. All right, we are buying the laptop on credit, so we get a rebate after we bought this on credit. So this will go to the Creditors Allowances Journal. All right, so the rebate basically is a reduction. All right, so it means that the supplier, we had, where is that? Let's look at that. So we had, this is the laptop we had bought. All right, and originally supplier had invoiced us for 5362. All right, and our invoice amount was made up of that entire amount. But then supplier decided to reduce our amount we owed by 179.52. All right, so we put it in the Creditors Allowances Journal, which is going to reduce that 5362.15. All right, so I'm sure you know how to work this one by now. So here you are buying inventory and you are getting a trade discount of that. So this is usually easy. If you want to calculate the amount on the spot and then you have a trade discount of 15, just say 100% minus 15%. It will give you 85%. So it means if you are calculating the amount without the trade discount, it will be 85%. So all that you do here is you say 5911.676 times 85%. All right? So it means if it's 10%, you just say 100% minus 10%, you'll have 90%. This time we've got 15%, so we just say 100 minus 15, and it gives us 85%. So we can calculate that. So that's fine. So we can just go to our calculator quickly. So here we go. So you can bring it up here. So we can cancel that and say 5911.76 times 85%. All right, when you say 85 on this calculator, you can say 85 and press percent, or 85%, you can say 0.85. So it will give you 5024. So it will be 5024. All right, so you just make it 5025. Okay, so that's great. So you're going to say 5025. All right, so what we're going to do, we're going to take a 5-minute break now, and then we will continue after that. So I'm sure by now you are able to determine where you need to take these transactions to, and you are able to calculate those tricky amounts with question marks. All right, see you after the break.